Hello, and welcome to this webinar on agriculture and climate finance. My name is Paul Faith, and I'm the Global Technical Director for Climate and Energy at Apt Associates. I'll be moderating the session today. As most of you likely know, discussions around nature-based solutions to mitigate greenhouse gas emissions and limit global warming have become very popular. Quite a bit of research suggests that the ag sector could represent a fairly large and potentially broad-based opportunity for relatively inexpensive mitigation efforts, while enhancing adaptation and resilience at the same time. The sector is facing some severe challenges, though, with input prices and interest rates way up in the last year or so. In today's webinar, we will discuss some of these and some other issues. Our panel includes Carolyn Stobe, Climate Adaptation Specialist at ACT, Songbei Lee, Ag Finance Team Lead at USAID, Jose Pugas, Partner and Head of ESG and Agribusiness at JGP Credito in Brazil, and Manuel Bueno, Director of Climate Finance at ACT. We won't take time with introductions. Everybody is on LinkedIn, so if you want to learn more about our backgrounds, you can go to LinkedIn and look us up. If you have comments as we go along, please post them in the chat for everyone to see. We think that will enhance our discussion. And we're going to be taking a look at those and saving some time at the end to address a few of those questions. I'm going to begin first this morning with Carolyn. And Carolyn, I want to ask you, just to be sure we're all starting from the same place in this discussion, please tell us about some of the production practices that can sequester carbon dioxide and what benefits they might have for agricultural adaptation and resilience.
Hi, Paul. Sure. So just to set the context a little bit, carbon is one of our natural resources, and it's a very important one. It disrupted the way that nature cycles carbon through the soil, through living organisms, and the atmosphere by burning massive amounts of fossil fuels and in many other ways. And too much carbon is escaping into the atmosphere, and as a result, the soil is less fertile and the atmosphere is heating up much faster than it should. Farmers can help keep carbon in the soil, for example, by minimizing soil disruption, by using reduced tillage or no-till, by protecting the soil from erosion, for example, by using cover crops, applying fertilizer, nitrogen fertilizer particularly, more efficiently. So in the right quantity at the right time makes a big difference too. The nitrogen is usually applied in excess, which ends up in the atmosphere as a greenhouse gas. Farmers who move away from specialized production towards diversified production, who use nitrogen fixing crops and integrate livestock within their fields, are all doing their part in capturing carbon. And aiming for local markets, of course, cutting the distance to the consumer helps reduce transport-related carbon emissions. And by focusing on regenerating and protecting the soil, farmers are not just helping curb global warming and emissions, but they are also reducing the risk of yield losses from shocks and building resilience back in the system.
Apologies for my coughing. That's going to happen throughout the whole thing. I'm sorry I avoided it. So, Carolyn, people talk a lot about climate smart agriculture. It sounds kind of like what you've been talking about. Could you tell us what that is, and then this context of climate finance, what that has to do with any of this?
Sure. So the term climate smart agriculture was coined in 2010 by the Food and Agriculture Organization, the FAO, in a report that showed that farming was negatively impacted by climate change and that greenhouse gas emissions from farming also made climate change worse. So climate smart agriculture, or CSA for short, was proposed as a set of strategies and technologies for farmers to use to address these two problems while also maintaining and increasing their yields. For example, we're talking about the use of stress-tolerant varieties, drought-tolerant varieties, right? Or the use of crop insurance, the use of climate information advisory services to optimize decisions, such as the selection of crops and the timing and quantity of irrigation and nutrient application in the context of the seasonal climate, right? So the practices I mentioned earlier, conservation tillage, cover cropping, nutrient cycling, crop diversification, these are methods that were always climate smart because they help restore soil fertility and keep carbon in the soil as well.
So when looking at climate resilient solutions in agriculture, what are some key considerations to keep?
Yeah, that's a really good question. So one important consideration is the need to contextualize strategies with farmers. I mean by that is investing in the same strategies and technologies everywhere and every year is a bad idea. It either doesn't work or it doesn't last, meaning that farmers might give it a try, but they'll soon revert back to their traditional practices after a bad season or two, right? So I've worked with large-scale farmers in Florida and small-scale farmers in Haiti, and this happens regardless. So it's important to ensure that farmers have access to quality, transparent information that they can trust, right? So that they can assess the risks and solutions by themselves every year, because every season is different, right? According to their own context. That's one thing. And that ties into the scalability idea, which is important as well. So scalability is important for strategies always, right? But instead of simply looking to scale up any particular farming practice or set of practices, I'd say it's about scaling up farmers' capacity to assess and plan for climate risks in order to boost the adoption of CSA practices and not just the testing of those practices. Another consideration is equity. To ensure that through the investment, all farmers, regardless of their background, can access, can use, can benefit from credit, quality seeds, fertilizer, information technology that they can use to make that transition, right, to climate smart agriculture. Smallholders, women, youth in particular, tend to struggle, right, with that because of socio-cultural factors that prevent them from owning technology or making livelihood decisions. Smallholders also face economic barriers. Very few have access to finance and capital, credit, tax incentives, right, subsidies, agricultural insurance. And that makes the transition really difficult, if not impossible in some cases. And I've seen that in Haiti. Other barriers include infrastructure barriers, right? We're talking about investments, and we have to think about access to irrigation. We have to think about access to roads that farmers can use year-round, right, to access markets and new markets. Storage facilities, right? These are often limited, so the farmers struggle to increase production and also develop links to new business, right? And then, of course, policy and regulatory barriers are also common. Land ownership is one I'd like to flag here. If land tenure cannot be protected effectively, farmers and commercial investors will be unwilling to invest long term, right? Justifiably. Yeah.
Thank you, Carolyn. I appreciate it. It's very
You're
interesting. I turn now to Songbei. Songbei, you lead an effort at USAID to promote climate finance in the ag sector. What sort of activities are you supporting to do that?
Yeah, I think so. I'm the ag finance person in our bureau called the Bureau for Resilience and Food Security. And I just want to start out, I know we're not doing introductions, but a little context. The person who's my counterpart in another bureau, Sashi, in the bureau called DDI, she also did finance, and then they changed her job to be fully focused on climate finance across the entire agency. Why do I bring that up? So she went from doing my job to being 100% climate finance, which meant for me, I avoided climate finance. For that reason, it's so big, it's like impossible for me just to carve out a little bit of my time to focus on it. It's an all day, more than all day kind of thing. But of course, it's inevitable and unavoidable. So yes, climate finance, specifically more adaptation finance, is something that's been creeping into my work, and I can give you a few examples. The first example would be the Responsibility Climate Smart Agriculture Food Security Fund. And I raise that as an example because this is a fund that's a new fund sponsored by KfW and designed with climate in mind front and center. So it's an agriculture fund, but it's climate focused. That's its priority. And the way we're supporting that is that through a DFC potential investment that has not been closed yet, but RFS, my bureau, is sponsoring a DFC investment into this fund. So that's the first example. The second example is Aceli Africa, and I see there's some people, at least Andrew from Aceli Africa, on the call. So if people have questions, they can chat him as well. Aceli Africa is not a fund, but is a market-based incentive facility. And here, climate is the secondary goal. So the primary goal for Aceli Africa is to mobilize capital for agricultural SMEs in Africa. But they also want to make sure that that capital is mobilized for impact. So they have a target that 20% of all the loans that they mobilize meet their criteria for climate smart agriculture. The last example is also, it's a new fund. It's being launched by MCE. And this fund, the name of it is MCE, Empowering Sustainable Agriculture, MESA. So in this case, it's not only climate, it's not, they don't have a target, but it is a strategic focus. So this fund, it's also an agricultural focus fund lending to agricultural SMEs. And there's two strategic focuses are climate and gender. So I think these are different ways that different funds can focus on climate and different ways that USAID can support them. In this case, USAID gave them an award, a contract specifically to help them with the design and the setup of the fund.
So, Sunday, if you could give us a little more detail, what are these funds going to do? How do people access these funds, and what sort of criteria, are they used for making selections?
Yeah, so they are all very different, and I'll try to keep it short, but happy to go into more detail later. So responsibility is going to be making loans specifically that have, reduction of, of carbon, or a reduction of food loss, or reduction in water usage. And they're going to be there. These are all actually, first of all, I'll say all debt focused. And responsibility is a large microfinance fund manager who's expanded into agriculture. And they have a team that goes out there and they're proactively looking for deals. So they're out there, that's their job, to go out and find deals and develop a pipeline. And they're going to be doing larger debt transactions. So above, let's just say easily above 1.5 million. And I use that number because Aceli Africa is targeting SMEs, and they do it by transaction size. It's a lot easier to segment by transaction size than by company size. And Aceli Africa targets deals with loans between $25,000 and $1.5 million. And here, Aceli Africa works with existing lenders, local lenders, and investment funds. So here, those lenders will actually be developing their own pipeline. So that's separate. And they are looking for their basic criteria for loans are that these are in the agricultural value chains and that they engage smallholder farmers. A minimum number of smallholder farmers, I think is 25. And then finally, MESA, it's interesting, they'll have a combination of agri-SMEs, very similar to the type of agri-SMEs that Aceli Africa focuses on, but they'll also be lending, part of their portfolio will be to microfinance institutions that serve a lot of smallholder farmers.
Fascinating. So as you've looked across in your experience across projects and programs, whether or not they're funded by USAID or somebody else. What do you see or expect will be the key elements of success for helping farmers to be more resilient, to adapt, and also potentially to mitigate?
It's an interesting question. I think Carolyn, touched on some of those points, and I'd also say she's probably a much better person to answer that question specifically. It's maybe less than an element of success at the farmer level. I can talk about a couple topics
at the macro. Yep.
I argue a lot with people about what we should be trying to do. And the first one is the focus on private capital. And of course, we want to mobilize private capital more. But my focus and a lot of my work has been trying to mobilize the DFC. And I see, USAID as a donor, our capital is on one end of the spectrum, commercial private capital is on the other end of the spectrum. And the DFC, a DFI, a development finance institution, I think sits fairly in between us. So it makes natural sense to use them as a stepping stone before we try to crowd in the private sector. Some folks in aid at USAID don't like the idea of US government money, USG money, subsidizing USG money. But I just think of it as a donor subsidizing or crowding in a lender. So that's the first issue. The second issue is the focus. I think we have overemphasis on the amount of capital mobilized. And we like this headline. It's easy to understand, but I think it's challenging as a metric because you could raise a lot of capital and not be having the impact you want. So I do think that we need to, one way I think of it is that people just focus on all the capital out there in the capital markets, but that capital is chasing high returns, risk-adjusted returns. And the transactions that we're focusing on, even more so in climate and agriculture, are going to be maybe developmentally oriented, but higher risk usually and or lower return. And all that capital out there is not going to be able to flow into those type of investments. So I just think a lot of my emphasis is not in trying to get a large number, but trying to support activities like Accelerate Africa, which are innovative and can build the evidence base, which I think would in the future influence policy, which I think where the real change would come.
So you mentioned working with DFC as one key tool that USAID has access to. Are there others that you have, grants or other sort of programs that you can use to, for agriculture?
Yeah, I think this is a really interesting topic that is so confusing, and it's usually in the weeds, but I'm happy to share just a little bit of a taste of it. So the first one you mentioned—
In the weeds is good sometimes because that's where there's a lot of interest that we found there.
So the DFC, the Development Finance Corporation, formerly called OPIC, and then you have the Development Credit Authority, which is a guarantee facility that used to be at USAID, moved over to OPIC, became the DFC, now called the Mission Transaction Unit. This is the first thing. They are the USAID transaction window at DFC. So to someone out there that has a more developmentally oriented deal, USAID can sponsor that deal for DFC to look at it. Then the other two main ways, and this I don't know why they make it so intentionally confusing. They call it acquisitions and assistance. Like, what does that mean? It means grants and contracts. So we do grants and contracts. So that's another thing. Then the other term we use is mechanisms. Like, what's a mechanism? So a mechanism is just branding. That's the simplest way I can say it. It's an activity and we give it a name, but it seems like it's its own entity. But really, it's just the name of an activity. So an example of an activity is Invest. It's called Invest. That's the brand. It's implemented by another organization, DAI, a similar organization to APT, as far as a USA contractor. And that goal of that activity is to mobilize private capital. And so that activity only did contracts, which was challenging to support the kind of funds I was talking about, because a lot of those funds want first loss catalytic capital, and that's challenging to structure as a contract. So now there's a new mechanism called GRIP, G-R-I-P, and this is an activity that right now is out for award. There's an RFP out. The interesting thing about GRIP, two things: it's focused on climate finance, so they want to mobilize climate finance. And the second thing is, I think, very proactively, because of the experience with Invest, they want to make sure that they'll have a grant component in addition to the contract component. And we can obviously, there's a lot of we can have a whole another discussion about the pluses and minuses of doing grants or contracts. But yes, to work with USAID, you do need to have a little bit of understanding of how we spend our money.
So have you used GDAs much in the climate finance space?
I'm glad you brought that up, and I'm surprised I missed that one. So the responsibility deal is us working with the mission transaction unit at the DFC. The MCE deal is a mechanism called Invest, and Aceli Africa is a GDA. So what is a GDA? A GDA is a Global Development Alliance. Again, I thought this was like a USA thing. No, it's just a name. It's the name of an activity. So confusing. In this case, all it means is a grant. And the GDA is under something they call an APS, which I can't really explain, but it stands for Annual Program Statement. And all it means is typically, like for Invest, they put out an RFP, a request for proposal, and people bid on it or respond to it, and then it's awarded. It's competitively bid. The GDA is a rolling window that people can apply for to get a grant. And usually the main component of it is that it's matching. Whoever applies has to bring some sort of matching component to whatever the support from USAID is. And Aceli Africa is a GDA, and under that GDA, we issued a cooperative agreement, which is another word for a grant.
Great. That actually is very helpful, Songbei. I really appreciate. I'm going to turn to Jose now. Jose, before we start, could you please provide a brief introduction to JGP? You're well known in Brazil, but perhaps in some of our other audiences, people who might be participating that might be less familiar with your work.
Sure, first of all, thank you for the invitation to be joining you during this event, and thank you for the audience to be available to listen to us talking and regressing about some topics that are so dear for us. JGP is one of the largest independent asset managers in Brazil. We exist for the last 2 decades, and we operate on different strategies on the financial sector, on wealth management, fixed income strategies, and public equity strategies and hedge funds. So we have very multiple company, and during the last 3 years, we have started full speed towards ESG compliance. So with that on our mind, we are the only asset manager in Brazil that has signed the deforestation-free finance commitment letter during the COP26. We are the largest signatory of the Latin America for the Net Zero Asset Management Initiative. And unfortunately, we are the only asset management on the Southern Hemisphere to have signed both the Net Zero Asset Managers and the Deforestation-Free Finance Commitment Letter. That, in our opinion, doesn't make any sense, but at least we are one of those that we are signatories of that. And on the last year and a half, we have started creating new products, new financial products that has ESG and mostly based on tackling deforestation as our core strategy for innovative finance products for Brazilian market.
That's great. That's very helpful. Thank you, Jose. I want to ask, the war in Ukraine is very much in the news, and impacts on agriculture and food security and the like. I'm wondering, and I'm sure our audience would be interested, what impact has the war in Ukraine had on the farmers that you work with in Brazil?
Well, we are agro-exporters in Brazil, so anything that happens across the world affects us directly, and the Ukraine war couldn't be different. What we have seen in Brazil in the last months, even a little before the war, we were already mapping those risks and already pricing the risks on our agricultural efforts in Brazil, was the increase on the input costs in general, mostly on fertilizers. In Brazil, we are very dependent on the importing of fertilizers. Brazil doesn't produce fertilizers enough for our agricultural production, and we have an increase over 70% on the cost of fertilizers in Brazil.
70%.
70%.
Wow.
Yes. So, for example, fertilizers and the whole inputs with the higher cost of chemicals and fertilizers and the other inputs, the whole margin of the producer has decreased more than 40% on this crop, considering the last one. And we are facing a reduction on the production, on the producer's margin on the last three crops, mostly on the smallholder. The large producer, they can hedge their production, can make better commercial arrangements, but the smallest ones, they're not able to do so. So they are the ones most affected by that. And with the economic crisis that was originated from this, from COVID and then Ukraine war and all the supply chain collapse that we have been facing and the deglobalization process that we are also facing on the last months, Brazil has applied higher basic interest rates. So nowadays, the basic interest rates in Brazil is 13.25% per year. So that's it's the basic interest rates. No one gets this basic interest rates. It's just it's just the country-based risk. So with those higher interest rates, the producers are more exposed to the fall, more exposed to financial distress, to the higher cost of capital that they're facing. And with the reduction of the Brazilian economic activity, the federal government that subsidized mostly of the loans for smallholders has presented much smaller yearly plan of subsidies for the federal loans, for the agricultural loans. So when we see that on the last year, the total costs of inputs of production has increased over 47% in total, the amount of capital available for the smallholders on a subsidized version of the loans in Brazil has increased less than 20%. So the total amount of loans available are much smaller than we needed. They were already smaller on the last three crops, and now they are even smaller than we had on the last crop. So even if the nominal amount is larger, the proportional value of the subsidies are much lower than we really needed in Brazil. And when we look at the ESG compliance loans, when we look at the sustainability linked loans and others that were also subsidized by the Brazilian federal government, it had a major reduction compared to the regular regular credit lines available by the federal government. So the most affected were the credit lines that were based on sustainability and low carbon agriculture.
So Jose, how has JGP adjusted its financing in the ag sector to account for these things and for climate mitigation and adaptation opportunities?
Well, when we signed the Net Zero Asset Management Initiative, we have decided that till the year 2040, we are going to be net zero across portfolio, not just on our internal emissions. And it's impossible in Brazil to be net zero if you're not deforestation zero. So when we signed the deforestation free finance, we decided that till the year 2025, 3 years from now, we are not going to be able to invest in longer commodity-driven deforestation. It has a huge impact on our portfolio. As you may figure, mostly of the Brazilian companies that are profitable, they are commodity-based companies, so they are very exposed to deforestation risks. So we had to apply a major re-engineering on our capital allocation strategies. First of all, we started considering some risks that were connected to the shortage of addressable markets. When we look at Brazilian commodity companies that they're not in compliance with European regulations, with US Forest Act, with UK Forest Act, we are an agro-exporting company. So if we do not have addressable markets, for sure there is financial risk, a market risk that must be applied on the analysis of the assets that we are investing on. So it's the first criteria that we have started applying on our portfolio allocation decision making. Also, we see an increase in the cost of capital of companies that are not ESG compliant. So we have a full connection, proportionality between the amount of the attractiveness of assets that can access cheaper capital and the ones that are not connected to those better loan conditions on international markets. So we also apply that on the discounts on the share price of the companies. And finally, we are also considering how the climate adaptation and deforestation risks are already jeopardizing some capabilities of production in Brazil. For example, all the projections, all the climate projections already considers that at least in 1 year of the next decades, Brazilian agricultural production will face the loss of the crop, the second crop. When we look at Brazil, the most competitive aspect of our agriculture is the second crop. But because of the lack of aerial rivers, as I said, that we are so much blessed by water that the rivers fly in Brazil. So we have the flying rivers that come from Amazon, from the transpiration of the trees that irrigates, that make it rain on the Cerrado region and on the Atlantic rainforest region. With the deforestation, we have less transpiration, we have less volume of water on those flying rivers, and the dry period between crops are getting even larger. With that,
Really?
with that phenomena, yes. With that phenomena, the probability of a second crop jeopardized by the longer drier periods is a real it's a real probability. It's material enough for us to start being concerned about the competitiveness of some regions for agricultural production in Brazil, mostly on the areas of transition between Cerrado and Amazon. That is one of our most producing largest producing areas on the grain production in Brazil. So there is a risk that, for example, we already committed to analyze and apply penalties on companies and on assets that are exposed to that kind of risk.
So by adjusting your strategy, what sort of impacts or behavior changes have you seen on the part of people that you traditionally would engage with?
Well, we adopted a double layer strategy here. The first one is education. So we are really engaged with companies and investors to provide the best education on climate changes and on deforestation risks. There's a lot of ignorance about the topics, not only in Brazil, but overseas as well. But in Brazil, with the size of our natural capital and representativity of our natural capital, ignorance is exponential on the risks of loss of this natural capital. And the second layer is based on active ownership. So we are helping companies to make the transition to deforestation free. And on those sides, we already have an active ownership fund to help companies that are exposed to deforestation risks to make the transition with the support of NGOs such as WWF, Tropical Forest Alliance, Global Canopy, and others. We help those companies, publicly listed companies, to make the transition to deforestation-free commodity production. And those companies are very engaged. We have been very successful on creating engagement plans with those companies to make them to be deforestation-free till 2025. It's not a question just to ask them to be deforestation free, but really help them to be deforestation free, almost on a consulting side with those companies. And on the second side, on our fixed income strategy, we have been created many credit facilities to support companies to change, to transform their supply chains on deforestation free and low carbon supply chains. So we are creating new financial facilities to help green procurement to achieve better results. And that's also been very successful on our strategy. I imagine that over 10% of the total AUM at JGP will be, to the end of this year, already ESG connected, but on this side of ESG, not as a risk management, but as a core strategy of those financial products.
Interesting, very interesting. Thank you, Jose. I appreciate it. So, Manuel, so you've heard what Jose was talking about, and I'm wondering what aspects of JGP's approach might be applicable in other regions. You know, they work in Brazil. It's a big world. What about, Asia, Africa? So what are your thoughts on what could be done to extend some of that kind of thinking?
Yeah. Well, I mean, I think in general, it's very important that we're service driven, right? And we really try to support investors like JGP to do well by doing good, right? Like I truly think it's very important to be service driven and to adjust to their own needs, right? And this means being a true partner to them and meeting them where they are now in terms of the stage of the fund. Jose talked about like their fundraising and Brazil's situation and the current challenges of their investees, in exchange for the commitment to impact, right? So look, Jose mentioned their fundraising, right? Well, let's help them fundraise based on their strategy and investors. Sure, we can start with the basics. Can we add a layer of subordinated grant or subordinated capital or grant capital to the fund, right? Can we get creative? Can we help offset their cost of any potential portfolio guarantee? One of the things that I think he also mentioned, or you might have mentioned, Paul, like, what about currency depreciation, right? If their fund investors are investing in USD and euros, great. We're seeing USD and euro currency like appreciating against the Brazilian real. Mm-hmm. How can we help offset the cost of a long-term currency hedge, which is expensive, even in a place like Brazil, which has like a relatively stable financial market, right? And what are the impact covenants for that support, right? Like, so if we go to JGP and we say, hey, look, how can we help you? What are the impact covenants that we're going to jointly commit, right? And then, Jose also talked about like how they're deploying their capital and how they're managing their existing portfolio, right? To adjust to that that sort of climate-related risks. So how do we help investors like JGP deploy their capital in exchange for those improved climate outcomes, right? And adapting for climate climate risks, right? So results-based grants that help offset interest payments to the borrowers for certain behaviors, right? Like climate smart the adoption of climate smart agricultural practices, right? Like maybe even, Jose and I have talked a lot in the past around like forestry. Maybe even we can extend the term of the loan to give the borrower a bit more breathing space in the face of like a very specific sort of external shock. Or in terms of forestry, like, you're planting new trees, it takes like, 5 years easily until they start generating a cash flow to the farmer, right? So maybe, we can be smart around, trying to extend the term of those loans and in the process mitigating the impact of those additional input costs to their portfolio, right? Importantly, let's just not also talk about pure finance. Not only that, let's talk about bringing in additional private sector partners. Like I think that's really, really important, right? Like let's bring in buyers which can commit to long-term procurement and help those farmers make more money. That's in my mind, like long-term procurement partners, that also counts as unlocking finance. And that's for both borrowers and lenders, that's very, very welcome, right? So to your other question, Paul, in terms of what aspects of JGP approach can be applicable to other parts of the world, I mean, the exciting thing about one of the reasons why I candidly like JGP is that they really like to work very closely with their investees, right? Like I've seen them be very active with their portfolio, and they. As long-term investors, they really try to help their investees make money by avoiding deforestation, and in some cases, like trying to reforest some of the land from their investees, right? So I think that approach is broadly applicable to other parts of the world, like that are seeing like really a lot of deforestation problems. That are seeing like they're increasingly sort of water stressed. As you say, like, I mean, we cannot sort of like grab that model and take it all over the world because it really depends on crops and supply chains and the financing landscape. Some of the examples that Sombe brought up, Aceli, they work a lot with banks and they do an amazing job. But then, when we're talking about long-term investors like the Mesa, the other example that Sombe brought up, those are funds, right? Let me stop here, right? But like to me, it's really about like being very service driven and saying, I'm going to a partner like JGP and say, hey, how can I make myself useful here? And how can I help you do well financially by doing good?
Right. Right. Thanks, Manuel. So, Carolyn mentioned at the beginning, and there's, the question of equity and, making sure that we reach a broad suite of farmers, not just the ones who are really directly involved in trade, et cetera.
Yeah.
So, question is for, there are millions, hundreds of millions of smallholder farmers. What about them? What about indigenous peoples? What sort of approaches or tools might be available to make sure that those people are included and can benefit from what, some estimates think will be really major flows of new capital in this area?
Yeah. I mean, that's a really good point, and I'm sure Jose will have a lot of thoughts and experiences as well. But in general, I mean, honestly, to me, there's a really important element around climate equity because it's the right thing to do, because these communities, these disadvantaged groups, are really disproportionately exposed to that set of climate to climate risks. But it's also that their active support is often crucial in making sure that those climate investments happen, as either as implementers or as enablers, right? So here I'm thinking, like, inclusion may not necessarily make an investment more profitable. In some cases it will, but without inclusion, a climate project, an investment in climate may just not happen, just may not be feasible, right? So I think, and that to me, like, are the two really important reasons for inclusion, right? Like, it's not only because I just transitioned, because climate equity is important, but also because without them, often, like, many of these things fail. So first I should say, but like, good inclusion is hard work. It's expensive, it's backbreaking, and even properly ensuring that you do no harm is hard work, right? And in terms of what we can do, right? I think technical assistance facilities, good technical assistance facilities to actively support certain disadvantaged groups are very important, are still very important, right? And personally, I think we need to think about these facilities with an expanded scope beyond what is standard, what is standard in many impact investment funds, right? Like, we need to go beyond engaging the investees of a portfolio to think through how to work through whole communities and through whole landscapes. Because, like, in many cases, like, your investee might be doing the right thing, but everyone else in that community, everyone else that has an impact in the landscape may not be doing the right thing, and so you still have certain landscapes and ecosystems collapsing, even though your investees are behaving in the right way, right? And whichever way we define right way. So technical assistance facility with expanded scope, I think it's a really important thing. I see some funds already going that direction, but it's hard because you need to raise more grant funding, in a nutshell. In terms of the design of support mechanisms to increase inclusiveness, I think some of the mechanisms that I mentioned before are really applicable here. And Andrew from Asteli is here. I think they do it very well, right? Like, they have a layer of support for improved climate outcomes, and then if there's inclusiveness if that investment also has an inclusive angle with women or disadvantaged groups, there's like yet an additional sweetener, right? Like, and probably I'm explaining this badly. Apologies in advance, Andrew. But it's essentially, in many ways, the way I think about it, a results-based grant to offset the additional costs of the bank in engaging those groups for those climate outcomes. And finally, I do think that we need to push ourselves to think about inclusion mechanisms to those communities, to those disadvantaged groups as a collective, as a group, right? To me, it's an issue of trying to partner with the whole group, not only with individuals of that group, and giving them, and thinking through how can we give them access to the financial benefits, and where it makes sense, a bit of control for those climate investments, right? So we've seen it in the past as well in the mining investments or ecotourism investments, forestry investments, where the investor and the project sponsor partner with a community, and they say, look, you as a community will have access to the financial returns for this project. And maybe there's a fixed component paid to the community, like you're renting that land for certain economic activities, or we're going to capitalize a community development fund that is capitalized with sales, with a portion of the sales, with a portion of the profits. You're trying to create jobs for that community. And then, in many cases, those communities have some degree of control over those projects, right? And it could be like veto rights over certain activities. And internally, we've talked about empowerment equity grants, which essentially means, hey, can we use our grant funding to buy an equity stake for the community to own a part of this project, right? And as I said, like this is not super new. Like we've seen examples of this in tourism, mining, forestry. I think I've seen a lot of this kind of things with fair trade certifications. And I think they have a lot of good lessons learned around community engagement and community development funds. So I think there's a lot of experiences that are outside of the realm of climate finance that we can bring to encourage this set of positive climate outcomes.
Great.
I'll stop here, Paul, but like I hope this was useful. Yeah.
Thanks, Manuel. I'd like to open up to other panelists. Carolyn, Songbei, or Jose. I wonder if you have any thoughts about, reaching smallholder farmers or indigenous communities to, so that they have access to these opportunities as well. Songbei.
Yeah, thanks. I think it's a really interesting question from a USAID perspective, and this is from what I perceive since I joined, that USAID worked more directly with smallholder farmers and has moved away from that. Now that moving away has been with the same thing of private sector engagement. They think work with the private sector, that's more sustainable. Do something with SMEs, also more sustainable. And I think a lot of smallholder farmers, that was thought as a continuous need for grant funding. So, and they want to do something that would be, more self-sustainable, which I agree with, but I think we might have moved too far and we can't leave them behind just because there is that need. It is huge, but I still, that's an area that even with my finance hat on, I try to grant funding, pure direct subsidy for that target group, I think is still important and necessary.
Thanks. Carolyn, you have a comment?
Sure. So I'm not a finance expert, but I think part of the discussion here is around the value of climate advisory services for smallholder farmers. So these are, what are these? These are approaches, they're tools, they're platforms that integrate climate information into the farmer's decision making, essentially. So we're talking about digital mobile applications, we're talking about radio, online platforms, right? Printed bulletins based on climate models, extension services that promote the use of climate data to make decisions. So returns on investments for digital climate advisory services providers range from 1 to 10 to 1 to 70. Returns to farmers in the form of productivity or income average 30% and 25% respectively. But the thing is, most farmers do not have access to climate services, and they are not created equal, meaning they're not always useful in building resilience. So I put a link in the chat here of a report. It's a blueprint developed by 150 stakeholders on the considerations to have in mind when developing or investing in climate advisory services, including data quality, equity, co-creation, accountability, financial sustainability, and scalability. Happy to talk more about that.
Great. Thanks, Carolyn. Jose.
Well, first of all, we don't, I think that on a smallholder strategy, we can't access them individually. The acquisition cost too high, and the risks are too concentrated in a single individual, cannot be diluted on a collective of individuals. It will, when to this very individual approach, not collective approach, you reduce the attractiveness of the financial for the financial sector. So you can multiply the catalytic capital of concessional funding, for example. So in that on our mind, we prefer always to convince to access cooperatives that are based on smallholders and mid-sized farmers, or connect to supply chains that can aggregate different smallholders on the same contract or on the same commercial practice. When we do that, you are transferring the risk of the individual farmer to the cooperative or to the off-taker. It's much better, much more convincing to the financial investors, traditional investor, to engage on this financial facility. The second one is how we can support public policies. There are already many public policies that are addressed to the smallholders. But for example, in Brazil, many of the smallholders can access subsidized federal government lines because they are not on they're negative on the credit and protection systems. So sometimes with just a little help, we can put that farmer back to the federal subsidies credit lines. So we have to support those federal policies, public policies. We cannot compete against them. It's not rational. We have to support and complement those public policies. And finally, we on the smallholders have to focus on legacy. So what we have created on many of our financial products are some covenants that can only be activated collectively. So in order, if you want to have an access to some benefits, these benefits will only be triggered if you are on a collective arrangement. So we can create this legacy as an associative and cooperative behavior of the smallholders, if we are never going to defend individualistic approaches.
That's really interesting to say. So we have a question from Antoine Faye of Senegal. This is directed at Songbae. The question is, are these USAID financing mechanisms you mentioned new, and the funding meant to comply with US pledges on climate finance contributions, or is this just traditional ODA financing that's being recycled as climate finance?
Thanks for the question. It's a good question, and we should separate two things. I'm sorry, just closing the window. They're mowing the yard outside. We have to separate mechanisms from funding. So the first thing is mechanisms do not come with funding. Mechanisms are just a way to spend the money. Someone else has to have the money. So the first thing, the mechanism is definitely new, specifically to spend money for climate finance. So Invest was just mobilizing finance, generally private finance. GRIP, the new mechanism, which hasn't been launched yet, will focus specifically on climate finance. Now, where will that money come from? So the short answer is there is no money, right? But we expect money, but we can't say for sure. Everyone just expects it. A good example is Ukraine. When the war started, we just assumed, get ready, right? Because what are we going to do in response? And we assume money will come, and then Congress approves the money, and now we're pushing that out to all our missions in the field. And I assume, though we can't say for certain, that new money will come for climate.
Okay, great. Thank you. We have another question from Ekanath Kadawada of Nepal. Climate impact has a cost and high risks. How do we incentivize to cover these costs and risks alongside the investment? Manuel, can I toss that to you to start?
Yeah.
Put you on the spot.
I think it's a really broad question. Like I'm a big believer in not reinventing the wheel. Jose, this is great. I was totally thinking about you. For me, it's not reinventing the wheel, finding the right local partners, the right local investors, and figuring out how to work with them, and figuring out, like, for instance, and Jose, with this, I'll pass it on to you. Like, one of the things that Jose and I have talked about in the past is, what does higher interest rates mean for existing borrowers in Brazil? And how do we, what is the impact of higher interest rates on those existing borrowers, many of which would be maybe over leveraged, right? And how do their risks, like that higher leverage from those farmers, how can we help reduce it with improved climate solutions. Me sitting in DC, I can come up with a bunch of ideas, and I can sort of like think through things that I've seen work in other parts of the world that I've implemented as an investor. But I think like local context is so crucially important, like so vital. And local context is not only about the farmers; it's about like the legal framework. As I said, it's about the local partners. Yeah, I feel like I'm rambling.
Right.
Jose,
Right.
I'm sure you have.
I'm gonna take the chair's prerogative. I'm gonna toss out an answer myself. One of the things strikes me that there's this continuum of, on one side, just purely private finance, which doesn't like these sort of risks, right? And can make these high costs and these high risks look unattractive. On the other side is purely development funding, which doesn't seek a return, and these risks are, acceptable because they don't want a return, right? But that money is very limited. So somewhere in between is this notion of blended finance. And, the Global Environment Facility has been doing this for quite some time on a variety of biodiversity and other things where the investors will put money in up to the point where it makes sense for them as an investor. And then for these high costs and to help absorb these high risks, then public finance can come in. And then what that does is that allows that public finance to stretch much farther than it ever could on its own by coupling and kind of peeling off, the profitable bit for private investors, and the high risk, expected less profitable bit can be covered by public finance. And in that way, by pairing these, there can be opportunities to address those sort of situations that question was. Jose.
I think that the first.
And then this will be the last response, and then we'll have to close out.
Okay, I try to be very brief. The first part of my answer, Bo has already explained perfectly about the additionality of the private sector on the public finance. So it's the first question. And the second one, how can we price a climate disaster? It's impossible to price that. So on a long-term perspective, on a value investment perspective, it's much cheaper to invest on climate finance than to not to invest on that. So for some examples, if I want to invest in an agricultural project that will last for at least 2 decades, in 2 decades, we are not creating climate adaptation, I will face a bankruptcy. I will face the failure of this project, and nothing is more expensive than bankruptcy. So there's the first aspect. And the second aspect is that with the new climate, when you approach on a planet finance mechanism using, for example, carbon credits, many of our agroforestry projects are now much more profitable than the regular grain production and cattle ranching because of the carbon credits, because of the ecosystem services. Mm-hmm. So when we are innovative on those new credit facilities with the new financial mechanisms, we can find profits that were considered just risks. So if we want to convert them and make those projects viable, we have to start thinking on profitability, on productivity, aggregating those new green revenues and risk analysis on the projects. When you do that, at my opinion at least, all my nature-based solutions and climate-oriented financial investments are much more profitable than the regular ones.
That's fascinating, and a great point for us to close out. I'd like to thank our panelists, Jose, Songbei, Carolyn, and Manuel, and thank all of our participants who've listened and contributed questions. We appreciate it. We will prepare this video and we'll put this out on our LinkedIn sites for those of us, and on App's site. So look for that, and if you have colleagues who might find this interesting, we'd appreciate it if you would pass that on. Best wishes to everybody for the rest of the week. Thank you very much.
Bye, everyone.
Bye-bye.
Bye bye. Thank you very much.